Hello and g'day to all the great Apex clients out there. Welcome to your June quarter market update. Sorry, it's taken me a little bit longer to get to this one, but there was some deep information to pour into with federal budgets and SpaceX. So, what we're going to do is run through a June quarter update, look at the year in totality for FY26, touch on a couple of federal budget points, and then take a look at SpaceX as an interesting and topical thing for the June quarter. So, when we look at our investment returns or commentary for the June quarter, we note that equity markets were particularly strong, rebounding from the uncertainty of the June quarter from the US and Iran conflict, which is good. That, along with positive, albeit slowing economic growth globally, was a really supportive backdrop for global equity markets and earnings growth. A return of certainty to the stock market, moderating interest rates globally, and expectations around that sent markets up, which is good. On the local market, however, we were weighed down by the opposite. So interest rate concerns to the upside, so worried about rates going up, economic headwinds around productivity and so forth, and a lack of technology exposure on our share markets. We're very heavy mining and financial services compared to global markets saw us underperform a bit. We saw bond markets perform well and end the year high or positive territory. And it's also good to see in the global market space, particularly in the US, that a broadening of of markets broadening outside the Magnificent Seven. So not just reliant on those big seven tech companies to drive returns. We saw other sectors and areas performing quite well. Now, looking at returns through the lens of the Vanguard High Growth Fund, which is a great proxy for global share markets, seeing that the quarterly return was up circa 9.17%, which is really great. And that was a nice rebound from the prior quarter where we saw negative returns of about 5%, noting that the year-end returns for that fund are about 13%, so really positive. When we break up the Vanguard High Growth, though, we get exposure to the S&P 500, which was up 14% for the quarter, the Euro Stock 50, which was up 12, the FTSE in London, which was flat, and then the ASX 200, which was 1.7. So this just shows diversification matters because the outcomes with these change year on year very rapidly, but on our shores, we're a bit of a laggard. And for FY26, we saw the S&P 500 plus 20.9, the Euro Stock 50 plus 22.9, the FTSE plus 19, and the ASX plus 6. So what a lot of us have been working on throughout the year is rotating over the last few years, really, with the asset managers' assistance, is rotating out of Australia and more globally because of productivity issues. Now, the Australian federal budget was an interesting one that we've all been talking about from May ad nauseum. So, on a high level, we saw some significant changes, particularly negative gearing in existing residential property, changes to capital gains tax and the treatment of capital gains tax, possible taxing of family trusts with minimum taxes. We saw some income tax cuts for people earning between 18,000 and 45,000. A positive note was superannuation and investment bonds went untouched. And so that is a very, very interesting point. Something else I noticed was greater investment in ATO compliance activity. So more funding for the ATO to pursue things like data matching and help police us a bit harder. And finally, zooming out, we're continuing to see the budget remain in deficit both in the near term and the long term. But what I'd like to particularly have a discussion about is just quietly, a lot of the budget was talking about changes to capital gains tax and negative gearing and how that impacts property. But I wanted to just explore it through the lens of shares somewhat. What we're seeing is that, yes, shares caught too by the changing capital gains tax discount, but I think that shares do walk through the budget changes a little bit stronger than property. So we're thinking about Stephen Bradbury just skating to the gold after the other skaters fell over. So the negative gearing crackdown was definitely aimed at residential property and not so much at shares, because gearing into shares, these debt recycling strategies, using your home equity to borrow and invest in shares, it's all still fully deductible. Unlike in the capital gains sense, unlike property, where a lot of the returns in property come from the capital growth and less so from the income of a portfolio. When it comes to shares, we note that a lot of the returns actually is derived from the dividends or the income. So we see that about a third to half of the returns come from the capital growth, and then a big chunk comes from the dividends. So it's a bit more insulated from those capital gains tax changes. Just importantly with that, I would say if any of this is of interest, or you would consult your advisor at Apex just to help understand what the changes mean for you. And it just led me to explore if you had invested in a Vanguard High Growth over the last decade under the old rules, where we enjoyed this thing called the general discount, which is basically if you owned an asset and it went up in value, if you and held it personally, and we own the asset for over 12 months, we get a 50% reduction on the gain, and then we're taxed on that gain at our marginal rate, versus the less favorable system now where the cost base is indexed up with inflationary type figures, and there's no general discount, and there's a minimum tax of 30%. Looking at the Vanguard High Growth, if we invested in it over 10 years ago at 5.4% growth, it's very nominal, the impact on tax under the old rules versus the new rules, whereas we're not seeing that with property. The difference is significant, and that's because a lot of the returns rather comes from the dividends and less so from the capital gains. So the CGT changes nowhere near as bad as for property and for shares than it is for property investment. And that's actually surprising when you run the numbers on this. Now, lastly, wrapping up with a conversation and a look at SpaceX. So really topical as a company that floated in the June quarter and hit the record book straight away. It's a question we were commonly asked through the quarter: is what is SpaceX? How is it sit in my portfolio? And how large is that exposure? And we can see with the beta shares or growth funds and the Vanguard high growth funds, it's a very nominal exposure. And that is because something that I actually learnt is that there are restrictions when companies go onto these indexes or indices. The S&P 500, so Standard and Poor's, S&P stands for, is the largest index provider over in America, and they have a 12-month wait period for index inclusion after a company floats or has their IPO. And they have some criteria for a company to come onto the index, things like free float, so how many shares are available to you or I, profitability and sustainability, as well as liquidity. SpaceX might come into your portfolios in a more significant way in the next 12 months, but at least for 12 months plus. And we all know that markets will vary in that time. So there you have it. That's your June quarter update, everyone. Please reach out to myself or your Apex advisor if you'd like to have a conversation about any of this or the budget updates. And we hope to speak and hear from you soon. Thanks very much. Take care. Bye.